Have you ever looked at a stock and thought, this could be the next big winner? That's exactly how many investors feel about NVTS. The company has exciting technology, operates in a fast-growing industry, and has attracted plenty of attention over the last few years. But here's the question almost nobody asks. What if the biggest opportunity is hiding the biggest risk? Because history has taught us one painful lesson. Great technology does not always create a great investment. Some companies become billion-dollar success stories. Others have amazing products, but their stock keeps falling. So where does NVTS really stand? Today we're counting down the top 5 risks every NVTS investor should know before buying another single share. And trust me, risk number 1 is the one most investors completely ignore. So make sure you stay until the end. Let's begin. Risk number 5, competition is becoming brutal. The semiconductor industry is one of the most competitive industries in the world. Every year, larger companies invest billions of dollars into research, manufacturing, and innovation. That means smaller companies have to keep improving just to survive. NVTS has developed impressive gallium nitride and silicon carbide technologies, but having great technology isn't enough. The real challenge is convincing manufacturers to switch from existing suppliers. Many customers already have long-term relationships with larger semiconductor companies. Changing suppliers takes time, money, testing, and confidence. If competitors release faster, cheaper, or more reliable products, NVTS could lose potential customers before deals are even signed. That's why investors shouldn't only watch NVTS. They should also keep an eye on the entire semiconductor landscape. Because sometimes the biggest risk isn't what your company does, it's what everyone else is doing. Risk number 4, profitability still matters. Here's something many new investors ignore. Revenue growth sounds exciting, but revenue alone doesn't pay shareholders. Profits do. Like many growth companies, NVTS has invested heavily in expanding its business. That includes research, development, hiring talented engineers, and building relationships with customers. Those investments could eventually pay off. But until the company consistently generates strong profits, investors should understand that financial pressure may continue. Markets can be patient, but not forever. If earnings disappoint quarter after quarter, even great companies can see their stock price fall sharply. That's why experienced investors don't just ask, how much is the company selling? They ask, how much money is the company actually keeping? There's a huge difference. Risk number 3, high expectations can be dangerous. Sometimes a stock doesn't fall because the company performs badly. It falls because investors expected even more. Think about that. If expectations become unrealistic, even good news may not be enough. That's one of the hidden dangers of exciting growth stocks. Whenever investors start believing a company will dominate an entire industry overnight, expectations become almost impossible to satisfy. One slower quarter, one delayed customer, one cautious forecast, and suddenly the market reacts emotionally. We've seen this happen many times across technology stocks. The lesson is simple. Never confuse an exciting story with a guaranteed investment. Sometimes patience wins, sometimes hype loses. And that's exactly why understanding risk is just as important as finding opportunity.